Siddhartha Bhaiya joins us now, and let's connect with him to understand that at a time when macros are looking great, where is he shopping and how is he churning his portfolio in the micros? When we spoke to him last time, he said, I don't own financials, I don't like IT. So then I asked him, what do you own? So let's take that conversation forward. So Siddhartha, good to have you back. Thank you for joining us.
Hi, good morning, Nikunj. Good morning, Aisha.
What's been your portfolio strategy of late? I mean, this is a market where if you bought the right stocks, you're actually making money like bandits.
I think nothing much has changed, to be honest with you, Nikunj.
Why has nothing changed? I mean, the stock prices have changed for sure.
Yes, stock prices have changed.
Okay. So how are you positioning yourself in terms of some of the ideas which we discussed? For example, last time you were underweight financials. You said
Correct.
that that's a concentrated trade. And for me, if I have to run a PMS scheme, if I do what others are doing, then how do I differentiate? And that strategy has worked for you. So have your top 3-4 holdings changed in last 3 months?
No, not actually. And I think the financials trade has kind of played off well. If you look at it, financials have underperformed and they continue to remain at risk with the US interest rates going up. And domestically, also, the liquidity has now become tighter from a surplus of nearly 2 lakh crores, 3 lakh crores. We're now at a neutral liquidity as far as domestically we are concerned. So we see interest rates going up in India as well. The yield gap between US and India has come down, has shrunk massively. So I think financials will remain at risk. I see both deposit rates and lending rates going up. So yes, I would still be, underweight financials.
You took a big bet in names like Avanti, Apar. All of them were very differentiated in mid-cap stocks. Where are you finding this opportunity in this market where you're not looking at what's happening to interest rates, you're not looking at the underlying tone and tonality of what is happening to the US Fed, but you're looking at the proposition of earnings which some of the companies have to offer? Where are you picking your spots right now?
See, again, as I said, the opportunities right now are far less and far few between than say a couple of years back right now. And I think I see a little bit of fatigue, Nikunj, again in the small and mid cap rally as well. Right, 6 months, we are now approximately 40% up in the small cap and mid cap space. After such a massive run, either you should have a consolidation or a little bit of a dip. So while long-term structural story looks good as far as India is concerned, short-term, I personally would be a little cautious in deploying fresh capital.
Okay, so does that mean, Siddharth, that you book out and get some profits off the table when it comes to small and mid caps, deploy that to large caps, or just sit on cash and keep the powder dry?
So we are Aisha, very long-term investors. So, the stocks that Nikunj mentioned, we've been holding for 7, 8, 10 years now. So that doesn't change our view. The only thing is we would probably, if we were to deploy fresh capital, we would look for better rates, maybe a slight dip or a slight consolidation or an improvement in the geopolitical or the macro front.
You've spoken about how the small caps being riskier than large caps is a myth. So can you elaborate a little bit more as to how exactly investors should be approaching the broader markets?
Again, as I said, I don't necessarily say that. Or I also go on and say that 90% of small cap is actually junk. So both statements hold true. I've seen enough large caps become penny stocks over a period of time, and majority of the large caps today that we see were small caps maybe 25, 30 years back. So it has to be a company specific approach, right? Capitalization doesn't matter. At the end of the day, what also matters is the revenues, the profitability, the growth rates that the companies are exhibiting, and the potential future from a long-term perspective. So yes, that is what we focus on, right? Our focus usually is very, very long-term, and we want to buy large companies at small market capitalization.
So that, I'm quite intrigued by why is it that it's a blanket call on banks? I mean, are all banks bad and are they all not going to make money? PSBs surely have given you a good return. Right. I understand that large cap, private banking names have not performed, not gone anywhere. But why are you so off from banks?
So there are two ways to play banks,
Sure.
right? One is, the banks itself, if the economy has to do well, typically banks will, as an overall, this will grow at 15 to 18% kind of a number. The other way is to look at where the flow of credit is going. And we tend to focus on industries where bank credit is flowing, and which we see over the last couple of years has gone away from consumerism to infrastructure to capital goods. So while the entire 20s, from 2010 to 2020 was more about consumerism, bank credit flowing to the consumer, I think the next 10 years and the last couple of years, and probably the next 7, 8, 10 years is going to be about credit flowing to the government, credit flowing for B2B, corporate credit, infrastructure growth, capital goods. So these are the sectors we feel credit is going to go to, and we are playing banks through that route. Obviously, we do own a couple of B2B financial institutions as well, which are into long-term infrastructure financing, but nothing as far as banks is concerned.
Amongst the list of sectoral bets, I'm curious as to what the outlook is when it comes to the media space, because not very many market experts, tend to look at this sector quite closely. So what exactly is the rationale? Is it the overall ad rates picking up? What exactly is, pulling you towards this space?
See, I open the newspapers and today I see 6 to 8 pages of advertisement on the front page. And particularly with all the IPO companies coming up. So whether it is print or whether it is digital or whether it is television, I think the valuations have corrected quite a bit. And they were kind of factoring in bankruptcy valuations, whereas their balance sheets were pretty healthy. At some point in time, say a year back, some of these companies had more than 50% net cash on their balance sheet, and they were available at 3 and 4 P multiple. Today, with elections coming in, ad rates are going to go up. With such huge IPO market, you're seeing demand for advertisement, even in newspapers and print, going up significantly, right? So, and with the Cricket World Cup also coming in. So yes, the valuations were attractive, and I think the growth has come back in, and hopefully the stocks will continue to re-rate.
Whatever you were just expressing in terms of thoughts, we are flashing it on the ticker. And we are flashing that short-term moves in the market do not derail the long-term story. You don't like financials, but the current portfolio holding, which you have right now, you're happy to own them for next couple of years. So can I say, and this is public information, Gujarat Ambuja Exports, Deepak Fertilizer, Apar Industries, Technocraft Industries, you see visibility for next 3 to 5 years in some of these names?
So Nikunj, to be honest with you, you never see visibility beyond a couple of quarters. Right? Even those couple of quarters, you kind of tend to get it wrong at times. So what you do is you buy stocks with a long-term perspective and then you monitor them closely on a quarterly basis.
Have you exited something completely because the valuations of where your thesis got challenged? There are only 2 reasons why you would exit, right?
Yes, correct. So typically is the first case where the valuations go out of whack, and that is where you would want to sell some of your holdings. Otherwise, we typically very few cases, if you buy with significant margin of safety, it's unlikely that in the long run you're going to lose money. Short run, yes, things can always go worse than what you predicted, but long run, I think.
So what have you exited? I mean, where have you said that, okay, I like the company, but I don't like the valuations, or I don't like the way the earnings trajectory or the management vision has transpired. I invested in this company because of A, but instead of A, it's become a small A.
So to be honest with you, Nikunj, there's hardly anything that we have exited in the last 3.5 years. The portfolio from March 20 to now, we've gotten more flows and we've added new stocks, but we hardly exited anything in the last 3.5 years. Anything meaningful. Maybe we would have booked a little bit of profits here and there because our positions have increased significantly. Like something like an Apar has run up 10x in the last 18 months. So we might have booked a little bit of profits over there because the portfolio weightages have increased significantly. But besides that, as I said, from a structural perspective, we were invested in, say, capital goods or power sector or infrastructure or railways way before anyone else was even looking at those sectors. And we were invested because the valuations looked attractive. We invested in media 12, 15 months back. At that point in time, nobody was looking at media sector. So kind of our vision is longer and we're willing to ride a multi-year wave rather than move in and out of stocks quickly.
You know, that's the other thing. It's not always about questioning how much the company can grow. It's also that, you know, the stock may have run ahead of itself. Do you sense that that could have played out somewhere in railways, or are you still sticking by with all your positions?
So a lot of these sectors, Aisha, haven't seen any capital investments or any capital allocation for the last 8 to 10 years. It's not that it's not a discretionary spend for us. Capital goods is concerned. I stay 15 minutes away from my office, and the signal practically drops 4 times when I'm making a phone call on my way home, right? So you look at the infrastructure, you look at the number of cars that are getting sold, right? The automobile sector had a record month last month. So you need more roads. You look at the airfares, they've gone through the roof. So you need more investments, whether it is hotels, whether it is railways, whether it is defense. All these things, they're no longer discretionary spends. It is a need of the hour if you want to grow at 7-8% GDP.
Yeah, get your point. Hopefully it happens sooner than later. But good to chat with you as always, Siddharth.
Thank you. Thanks a lot. Thanks.
Okay.